Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Intellia Therapeutics.
If you find our talks useful, please consider subscribe, like, and comment underneath. So when you're building a wealth strategy, you generally look for, visible incremental growth, right?
Yeah, exactly. The safe stuff.
Right, like a software company adding new subscribers or, a retail chain opening 50 new stores. The progress is very linear. You can track it quarter by quarter. But the moment you step into the world of biotechnology, that linear model it completely fractures.
Oh, it shatters. Biotech is entirely binary.
Completely binary. I mean, a company will spend a decade burning through billions of dollars in research and development, and then they cross this massive threshold. They either transform into a commercial empire or, well, they're left with absolutely nothing.
Right, and moving from a purely clinical stage research outfit into a commercial stage powerhouse that is arguably the most dangerous and frankly potentially lucrative chasm in modern medicine. Because you're shifting from just proving that a drug works in a lab, to proving that a business can actually sell it in the real world.
And we're watching a company try to jump that exact chasm in real time today. I mean, if you hold Intellia Therapeutics in your portfolio, or even if you're just tracking the whole gene editing space, you're looking at this incredible collision right now.
The collision of science and finance.
Exactly. You've got this groundbreaking science, literally a one-and-done genetic cure running head-on into the cold, hard financial realities of the public markets.
Yeah. And before anyone gets, swept up in the narrative of a miraculous cure, because it is amazing, the analysis really has to start with the balance sheet.
Always.
Right. The most elegant science in the world just cannot survive if the bank account runs dry, say, 6 months before the FDA actually grants approval. We have to establish if their financial foundation can even support the weight of a massive commercial launch.
So let's look at those numbers. Looking at their Q4 2025 report, which came out late February, the top line looks fantastic.
All right.
Revenue hit $23.02 million.
Which is a massive jump.
Right. A 78.4% jump year over year. It completely crushed Wall Street's estimate, which was just sitting at 12.17 million.
But I think it's important to clarify for folks, for a pre-commercial biotech, revenue does not come from selling a drug to patients yet.
Oh, right. Because they don't have an approved drug on the market.
Exactly. It comes from strategic partnerships and collaboration milestones.
Okay, so who are they partnering with?
Well, posting a 78% jump in that top-line number, it validates that their collaboration streams, particularly their co-development agreement with Regeneron Pharmaceuticals, are highly active.
Regeneron, wow.
Yeah, big players. The industry partners are seeing the clinical data, they clearly like what they see, and they are literally writing the checks to keep these programs moving forward.
That makes sense. But here is where traditional fundamental analysis starts flashing warning lights. I mean, they beat on revenue, sure, but the company is still deeply unprofitable.
Very much so.
The earnings per share came in at negative 83 cents. Now, that did beat the street's estimate of negative 99 cents, but it leaves us looking at a negative net margin of over 600%.
Which sounds terrifying.
Right. If you're used to analyzing tech or industrials, a negative 600% margin sounds completely catastrophic.
It does, but contextualizing that margin, you really have to understand the biotech life cycle. A steeply negative net margin is basically the standard operating procedure right before a commercial launch.
Because they're ramping everything up.
Exactly. You're entering the single most capital-intensive phase of the entire business. You have to scale up commercial manufacturing, you're building out national sales teams, hiring medical science liaisons, and navigating the immense regulatory costs of the FDA.
So you're spending maximum capital before a single commercial treatment is ever even administered to a paying patient.
Precisely. And that's why analysts are projecting this massive future revenue growth around 106% as commercialization actually nears. The operational leverage flips entirely once the drug is approved.
But surviving that capital-intensive phase,
Right.
I mean, that requires a massive war chest.
It really does.
So looking at their cash position, they reported $500 million in cash and marketable securities. And crucially, they actually hold more cash than debt.
Which is fantastic. Maintaining a net cash positive position is a remarkably defensive posture for a biotech at this stage. Management previously guided that this cash pile alone would give them an operational runway well into the first half of 2027.
Okay, but this brings up a major point of friction for anyone holding this stock right now. Because if they have $500 million in the bank and the runway extends into 2027, why did management just commence a $150 million public offering of common stock?
That's the big question.
Right, diluting shareholders when you ostensibly have the cash to survive, it seems like a surefire way to just anger your entire investor base.
It does, but honestly, raising capital from a position of strength is a hallmark of highly experienced biotech management.
Even with the dilution.
Yeah, look, issuing new shares definitely dilutes the current equity. It suppresses the stock price in the near term. But management is looking at the aggressive upcoming launch of their lead drug, Lonvos.
And the pipeline expansion, right?
Exactly. They're expanding the ATTR clinical program. And just for context, ATTR, or transthyretin amyloidosis, is this fatal progressive disease where misfolded proteins build up in the heart and the nerves.
Oh, wow. That sounds incredibly complex to treat.
It is. And expanding clinical trials for a disease state that complex is astronomically expensive. So by raising that $150 million today, they're basically securing the balance sheet against future macroeconomic shocks or unexpected FDA regulatory delays.
So it's defensive. They never want to be in a position where they are forced to raise money 6 months from now just to keep the lights on.
Exactly. They are essentially buying an insurance policy for their own commercial launch.
Okay, I get that. They take the dilution hit today to guarantee they cross the finish line tomorrow.
Perfectly said.
And what they're bringing to that finish line is really the core of their valuation. Intellia's primary advantage is their in vivo CRISPR-Cas9 gene editing platform. And I want to break down the mechanics here, because understanding this science is totally essential to understanding their financial moat.
Yeah, the science is wild. The distinction between ex vivo and in vivo therapy is literally everything.
Break that down for us.
So older cell therapies are ex vivo, meaning out of the body. The current standard involves literally extracting a patient's cells, freezing them, shipping them to some specialized manufacturing lab.
Which sounds like a logistical nightmare right off the bat.
It is. Then they genetically modify them over several weeks and finally infuse them back into the patient. It's incredibly expensive to manufacture, and it's physically grueling for the patient, who usually has to undergo these harsh conditioning regimens first.
But Intellia completely bypasses that whole supply chain nightmare, right?
Right, because in vivo means inside the body. They use lipid nanoparticles, which you can think of as like microscopic delivery trucks.
Microscopic delivery trucks. I like that.
Yeah, and they wrap up the CRISPR molecular machinery inside them. They infuse that directly into the patient in just a single administration. And those tiny trucks home in directly on the target organ, which in this case is the liver.
Wow, so the genetic editing happens right there inside the patient's own body.
Exactly. The mechanism of action is profound. When we look at their competitors offering chronic treatments, specifically RNA interference or RNAi, therapies, we're looking at two entirely different approaches to medicine.
How so?
Well, RNAi treatments temporarily silence the RNA that causes the disease, but the underlying genetic mutation, the actual root cause, is still there.
Oh, I see. I look at RNAi like dealing with a leaky roof by just putting a bucket in the living room.
That's a great analogy.
Right. It manages the problem, sure, but you have to keep emptying that bucket forever. The patient has to keep returning for continuous lifelong dosing.
Yep. Whereas Intellia's in vivo CRISPR approach, it sends a molecular carpenter up there to permanently rebuild the roof. It cuts the DNA, fixes the root cause, and the leak stops permanently.
That one-and-done curative potential that creates an incredibly durable competitive moat. I mean, the FDA even recently lifted clinical holds on their magnitude trials based on safety data spanning, what, roughly 650 patients?
Yeah, around 650, which is massive. Generating a safety database of that size for a novel gene therapy, it provides massive validation. It proves to regulators that sending these lipid nanoparticles into the liver is fundamentally safe across a wide population.
Okay, so when you take solid fundamentals, a fortified balance sheet, and heavily validated science, you'd expect the stock chart to reflect this smooth upward trajectory.
You would think so.
But when you look at the price action, it resembles a psychological battleground. I mean, the market is fiercely debating how to price this transition from clinical research to commercial reality.
Oh, the technical setup for this stock right now is defined by extreme volatility. We are watching a real-time tug-of-war between the clinical data and the commercial doubt.
Right, because the stock went on this massive run in early 2026, climbing more than 50% year to date.
It was a huge rally.
Yeah. When the company announced positive Phase 3 AOLO trial data, the stock showed explosive momentum, ripping right through its 20-day moving average. But, what goes up rapidly in the biotech sector almost always faces an aggressive wave of profit-taking.
Always. It's almost guaranteed.
And we saw a textbook sell the news drop. Even with phenomenally positive trial results, shares actually fell during parts of that trading session. And the stock is down roughly 10 to 15% over the past week.
Yeah, investors who rode that 50% wave saw the positive data, realized the expectations were already fully baked into the current valuation, and just decided to lock in their gains.
Makes sense.
And if you combine that profit-taking with the overhang of the $150 million stock offering we just discussed, you create really heavy downward pressure.
But the structural trend beneath that short-term volatility remains highly bullish, right?
It does. If you look at the moving averages, the 50-day moving average sits at $13.57, which is cleanly above the 200-day moving average at $12.97.
Okay, so for technical traders, that signals the longer-term momentum is still pointing upward, despite all this weekly chop.
Exactly. And the trading volume absolutely confirms that institutional repositioning is happening behind the scenes. We saw volume surge to 18.6 million shares traded.
Wow. Compared to a normal daily average of what?
Just 4.7 million?
That's a massive spike.
Yeah.
But the options chain is where the story gets really fascinating. Traders bought nearly 6,000 call options in a single session. That's 92% above the average call volume.
Right, and seeing call volume spike that dramatically on top of 18 million shares traded, that is a massive tell.
Meaning what exactly?
The institutional money is placing highly calculated bets. They are either aggressively hedging their existing portfolios, or they're staking out massive bullish positions ahead of incoming regulatory developments. They are treating the short-term pullback as a temporary mispricing.
Okay, so to understand why the institutional money is polarizing like this, we need to look at Wall Street's interpretation of the catalyst itself, which is that phase 3 halo data for the drug lonvos.
Right, and the halo data, it met all primary and secondary endpoints.
Every single one.
Every single one. They demonstrated an 87% reduction in disease attacks, accompanied by a perfectly clean safety profile.
Wow.
Yeah, this was not some borderline statistical victory. It was a definitive landmark success that immediately triggered a rolling biologics license application, or BLA, submission to the FDA.
And a rolling submission is a massive advantage in biotech.
Huge.
Because instead of waiting until every single module of this massive FDA application is finished to submit it all at once, Intellia can just submit sections of the application as they complete them, right?
Exactly. The FDA reviews the data on a rolling basis, which accelerates the timeline significantly. It puts them on a very clear runway for a U.S. commercial launch in the first half of 2027.
But Wall Street's reaction to that timeline is completely bimodal.
Yeah.
I mean, you have heavy bullishness on one side and extreme caution on the other.
Yeah, the analysts are really split. For the bulls, Leerink Partners raised their price target to $35, and their analyst notes explicitly stated they're increasing the probability of success for lonvos to 90%.
That's a huge vote of confidence.
It is, and Citizens raised their target to $30. Their rationale is actually particularly interesting because they value the HAE clinical program alone at $18 a share.
Wait, so by their math, if you buy the stock today,
you are getting the entire rest of the company's pipeline for free.
That's incredible. And Chardon Capital is holding a $30 target. TD Cowen reiterated their buy rating, and William Blair upgraded the stock to outperform. So the bulls are roaring.
They are. But on the cautious side of the aisle, you have Morgan Stanley maintaining an equal weight rating with a $15 target.
And they represent the doubt.
Right.
The doubt premium.
Exactly. They see that $150 million dilution. They understand the astronomical costs of launching a novel gene therapy. And they're basically advising clients to wait and see if management can actually execute the commercialization phase.
Which brings us to the ownership structure, which is just wild. The institutional ownership of Intellia stands at a staggering 88.77%.
Almost 90% of the entire company is locked up by professional asset managers, hedge funds, and institutional desks.
Now, if you're an individual investor looking at that metric, it raises an obvious question. If almost 90% of the stock is held by the smart money, what is keeping the valuation from breaking out completely? I mean, are these institutions just parking their capital and waiting for a big pharma buyout?
Well, high institutional ownership means the public float, the shares actively traded by retail investors, is incredibly low, which naturally exacerbates the volatility we're seeing on the charts.
Right, because there's less liquidity.
Exactly. But the M&A speculation, the buyout rumors, that's a persistent undercurrent here. Intellia is a profoundly logical acquisition target for legacy pharmaceutical companies.
We really have to look at the massive patent cliffs hitting the industry in the late 2020s.
Oh, it's going to be brutal for them.
It is. Companies like Bristol Myers Squibb, Merck with their oncology blockbuster Keytruda, and Johnson & Johnson, they are staring down the expiration of patents on drugs that currently generate billions in annual revenue.
Those companies are facing a devastating revenue cliff, so they cannot rely on internal R&D alone to replace that lost income. They desperately need to acquire external innovation to replenish their pipeline.
So acquiring a fully validated, de-risked in vivo gene editing platform like Intellia's that solves a massive long-term structural problem for a big pharma player.
Absolutely. Because they wouldn't just be buying a single drug, they would be buying the foundational technology to engineer an entirely new pipeline of cures.
Okay, so we've established the tension defining this stock. On one side, you have this bullish, curative science and massive institutional backing. And on the other side, near-term dilution and the grueling mechanics of a commercial launch.
It's quite the setup.
So to determine when this stock might finally break out of this holding pattern, we need to map out the catalyst calendar, what's coming up.
The most critical near-term inflection point occurs between June 12th and the 15th, 2026. Intellia will present the highly detailed Phase 3 AA-low data at the AACI Congress in Istanbul.
Okay, so right now, the broader market just knows the headline ending of the movie, right? The drug works, and it reduced attacks by 87%.
Right. But the medical presentation in June, that is the director's cut.
The deep dive into the data.
Exactly. The market, and specifically prescribing physicians, they want to see the granular details. They want to see the swimmer plots that map out individual patient journeys over time.
They want the specific subgroup analyses to see if the drug works better in certain demographics.
Yeah, that detailed data package is what will prove exactly why this one-and-done cure is clinically superior to the chronic RNAi options currently dominated by competitors.
And Leerink and the other bullish analysts expect that level of granularity to further differentiate Longbows.
They do. And once we get past the June data reveal, the calendar shifts from scientific catalysts to operational milestones.
Right, like in late July or early August, we'll see their Q2 earnings report.
Right.
Wall Street is going to hyper-focus on the specific line item costs of their commercial preparation.
And simultaneously, the market will be tracking the final completion of that rolling BLA submission we talked about.
Don't forget the macroeconomic environment, too. It plays a massive role. The entire biotech sector is acutely sensitive to interest rate shifts.
Extremely sensitive.
If we see a dovish shift from the Federal Reserve, capital tends to rotate aggressively out of defensive sectors and back into high-growth, innovation-led equities. A scientifically de-risked story like Intellia would disproportionately benefit from a sector-wide rally.
For sure. But, building wealth requires stress testing the bullish thesis. Regardless of the macro environment, we have to clearly identify the hurdles that could actually derail this path to a 2027 launch.
Absolutely. So what's the bear case here?
The bear case revolves around two major risks. The first is technical, that $150 million offering. It acts as a heavy ceiling on the stock price in the near term. Every time the stock tries to rally on good news, the market has to absorb millions of newly issued shares.
Which suppresses the momentum. It's just a simple supply and demand bottleneck.
Exactly.
Okay.
But the second risk goes much deeper into the structural economics of the healthcare system. It's the actual commercial viability of a cure.
This is fascinating to me, because even if the science is flawless, you still have to convince the payers, the major insurance companies, to actually cover the cost.
And the insurance model is just not inherently built to handle cures.
Why is that?
Well, think about it. If a competitor offers a chronic RNAi therapy that costs, say, $50,000 a year for the rest of a patient's life, the insurance company can easily model and spread that cost out over decades.
Right. But a curative gene therapy might carry a one-time upfront cost of like $2 million.
Exactly. And that math creates a massive disincentive for the insurer. If an insurance company pays $2 million to cure a patient today, they assume all the financial risk.
Oh, I see. Because statistics show that employees change jobs and therefore switch health insurance providers, every 3 to 4 years?
Yep. So the first insurer absorbs the massive upfront cost, and 3 years later, a rival insurance company reaps the financial benefit of having a perfectly healthy patient on their rolls.
Wow. It is the great paradox of modern biotech. The very fact that a drug permanently cures a patient makes it a financial liability for the payer under the current system.
It's messed up, but it's true. Furthermore, Intellia has to overcome generalized market fears regarding liver toxicity.
Even with the clean safety profile.
Yeah, despite the flawlessly clean safety profile demonstrated in the HALO trial, older generations of gene therapies really struggled with liver inflammation.
And competitors selling chronic RNAi drugs are absolutely going to weaponize that history.
Oh, without a doubt. Their entire marketing pitch to doctors and insurers will be based on fear. They'll argue that while their drug requires constant dosing, it has a decade of known safety data.
Right, whereas a permanent genetic edit carries unknown long-term risks.
Exactly. They are going to fight fiercely to protect their recurring revenue streams.
So weighing the groundbreaking science against the realities of dilution, payer pushback, and competitor fear-mongering, it requires synthesizing a final verdict for the portfolio.
Let's hear it.
Based on the fundamental foundation, the technical momentum, and the validated science, this lands at an 8 out of 10 on our bullish score.
I agree with that. The thesis for that 8 out of 10 is straightforward. Intellia Therapeutics has crossed the clinical Rubicon.
They really have.
They haven't just proved a concept in a petri dish. They have validated the first ever in vivo CRISPR curative therapy in a massive phase 3 trial. The foundational scientific platform is fundamentally de-risked.
And the market is currently mispricing the long-term durability of that competitive moat simply because it's overly focused on the short-term dilution and the complexities of insurance coverage.
Spot on. But the time horizon is the most important variable for anyone holding this stock. This is not a high-frequency trade designed for a quick flip next week.
No, definitely not. It is a multi-year hold, strategically positioned to capture value through the FDA approval process and the actual commercial launch in the first half of 2027.
Right. And over the next few months, specifically around that detailed data presentation in June, the goal is to watch the broader market narrative transition. It needs to shift away from data versus doubt and move firmly into commercialization imminent.
And, when you zoom out from the specific valuation of this single stock, the implications of this transition are just staggering.
Completely. If Intellia successfully launches in 2027 and achieves commercial adoption, it does much more than just validate their internal pipeline. It forces the entire medical industry to pivot.
It fundamentally disrupts the underlying business model of modern medicine. We're looking at a transition away from a subscription model of treating symptoms indefinitely and moving toward definitive one-time genomic fixes.
It's the future.
It is. So if you're managing a portfolio in this space, keep a very close eye on how legacy big pharma companies react to this incoming shift over the next year. Because when groundbreaking science finally forces the financial realities of the world to adapt, that is where generational wealth is built. We'll see you next time.